The pound just gapped lower, and right now it's sitting on a knife edge, the 200-hour moving average at 1.3364. This level has held as support since June 29th. But here's what most traders don't see. The same level that's been propping up sterling for 2 weeks is also the most obvious stop-loss magnet in the entire market. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 2 scalp plays and 1 swing trade you can execute today, before tomorrow's US CPI data drops and potentially changes everything. Here's the verdict. We are fading. The recovery from 1.3160 has officially hit the buffers. The pair rejected the 1.3450 area, failed to hold above 1.3400, and now we are testing the 200-hour MA at 1.3364. This is a critical moment. Write this number down, 1.3364. If we break below today with a sustained 4H close, the entire bullish structure from late June resets. And if we hold, we are looking at a bounce back toward 1.3399. That's the confluence of the 100-day MA, the 200-day MA, and the 50% retracement from the May low. That's your invalidation level. Here's where the herd is positioned. Large speculators and asset managers have been reducing their net short exposure to the pound by a combined 27.3 thousand contracts in the latest COT data. That tells me the smart money has been covering shorts. But with the dollar now finding bids on geopolitical risk, that positioning could flip fast. Let's read the chart. From the top down. On the weekly, trend is neutral. We are still inside the broader range. But the daily, that's where the story gets interesting. Pound sterling to US dollar is trading below the triple simple moving average cluster at 1.3391. That's the 50-day, 100-day, and 200-day Mars all converging in the same zone. This is what pound sterling live called one of the strongest resistance zones on the chart, where the descending trendline converges with both the 50-day and 200-day moving averages, drop down to the 4H. The structure remains inside a bullish framework, but momentum is weakening as sellers defend the highs. The 4H MACD is rolling over. We are not seeing a bearish cross yet, but the histogram is shrinking. Momentum is fading. Now the 60-minute, this is where the battle is happening right now. Price is testing the 200-hour moving average at 1.3364. The pair has not been below this MA since June 29. Repeated failures above the 1.3399 resistance cluster have shifted the near-term bias back in favor of the sellers. Here's what most traders miss. The 1.3364 level isn't just a moving average. It coincides with the Asian session low and the upper boundary of a double bottom pattern that formed on the M5 chart at 1.3365. This is a liquidity magnet. Stops are stacked on both sides. Support levels. S1 at 1.3372, S2 at 1.3359, S3 at 1.3349. Resistance. R1 at 1.3395, R2 at 1.3405, R3 at 1.3418. The pivot sits at 1.3382. The 5-period MA is at 1.3379, the 20-period at 1.3347, the 50-period at 1.3363, and the 200-period at 1.3372. We are literally trading inside the MA cluster. That's why volatility is about to explode. The ADX at 32.5 tells us we have a trending market, but the CCI at 61.8 is neutral, not overbought, not oversold. RSI at 51.4 is dead center. The Williams %R at minus 30.5 suggests we are not at extremes. This is a coiled spring. And tomorrow's US CPI is the trigger. Let's connect the dots on what's actually moving this pair. The dominant driver across G10 markets right now is energy, not domestic monetary policy. That's straight from Chris Turner, global head of markets at ING. Renewed US-Iran strikes push Brent crude up over 4% to $79 a barrel. Oil up, dollar up. That's the playbook. The weekend saw US and Iranian forces exchange heavy missile and drone assaults, with Tehran targeting US facilities across the Gulf and saying it had again closed the Strait of Hormuz. This rain flames concerns that if energy prices rise from here, we could start to see rate hikes pulled forward. Fed funds futures are now pricing an implied 50.9% probability of 2 or more rate hikes by December, up from 47.6% on Friday. But here's the nuance, and this is what separates the pros from the amateurs. The pound's pullback is not driven by UK fundamentals. Domestically, the political transition is orderly. Andy Burnham is set to be confirmed as Labour leader this Friday, and formally appointed Prime Minister next Monday. Sterling's resilience through the political uncertainty suggests the transition is largely priced. The retreat below $1.34 reflects purely external forces, oil, the dollar, and risk sentiment. Markets still price at least one Bank of England rate hike by year-end, which limits the pound's downside. The 1 to 2 week directional lean, range-bound with a bearish bias heading into CPI. UOB analysts Kwek Serling and Lee Suan judge that the advance from late last month has ended and expect GBP to trade in a 1.3320 to 1.3445 range in coming weeks. To break below 1.3360 opens 1.3320. A break above 1.3410 means the immediate downward pressure has faded. Do you think the dollar breaks higher this week on CPI? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 3 setups. 2 scalps for the active trader. 1 swing for the patient player. All 3 are based on the same structural reality. We are at a critical inflection point at 1.3364, and the resolution will be explosive. Strategy 1. The opening snipe, scalping, high probability. This is your high probability scalp for the London or New York session open. The trigger is simple. We are looking for price to tap the 200-hour moving average at 1.3364 and print a bullish reversal candlestick pattern on the 5-minute chart. I want to see a hammer, a bullish engulfing, or a clean pin bar with a long lower wick entry. 1.3368, that's 4 pips above the 200 MA, after the bullish reversal signal confirms stop. Loss, 1.3354, 14 pips below entry, just below the S2 support at 1.3359 and the overnight low. Take profit 1. 1.3388, that's 20 pips, a clean 1.4 to 1 risk reward. Take profit 2. 1.3395, the first resistance level. If momentum extends, we trail. What instantly voids this scalp? A 5-minute candle that closes below 1.3360. If sellers take that level with conviction, the 200 MA has failed, and we are not buying the opening snipe entry. 1.3368, 5M bullish reversal candle after 200 MA tap, stop loss. 1.3354 take profit 1. 1.3388 take profit 2. 1.3395 risk, reward. 1:1.4R, TP1. 1:2.3R, TP2, invalidation. Void if 5M candle closes below 1.3360. Strategy 2. The liquidity grab, scalping, counter noise. This is the counterintuitive play. Most traders will buy the bounce off the 200 MA. The smart money knows that the real liquidity sits below. Stop losses from all those long positions are stacked from 1.3350 down to 1.3320. So here's the setup. We want to see price break below the 200 MA, trigger all those stops, sweep the sell-side liquidity, and then snap back. This is a classic fake-out on the 15-minute chart. I'm looking for price to break below 1.3360, drive down to the 1.3349 to 1.3350 area, that's S3 support, and then print a bullish reversal candle with a long lower wick. The false breakdown traps the sellers who chase the break, entry, 1.3355, after the snapback confirmation, when price reclaims the 200 MA on the 15-minute, stop loss, 1.3338, just below the 1.3349 S3 level and above the 1.3338 target that investinglive.com identified as the next downside level if the 200 MA breaks. Take profit. 1.3382, the pivot point. This is the nearest intraday liquidity pool. It's a clean 17 pip target against a 17 pip stop. 1-to-1. Warning. This requires fast execution. The fake out will happen quickly, and the snapback will be violent. If you hesitate, you miss it. What invalidates this? If price breaks below 1.3338 and holds. That means the sell-off is real, not a liquidity grab, and we are heading to 1.3323, the liquidity grab entry. 1.3355, 15M bullish reversal after stop sweep below 200 MA, stop loss. 1.3338 take profit 1. 1.3382 risk, reward. 1:1.0 R invalidation. Void if 15M candle closes below 1.3338. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment. This is for the patient trader who wants to capture the multi-day move. The structural reality is this. We are in a range between 1.3320 and 1.3445 according to UOB, with broader 1.3210 to 1.3655 levels on a 1 to 3 month view. The swing trade is about catching the next leg within this range. I want to see a 4H close above the 60-period moving average with a bullish MACD cross. Confirming. The 60 MA on the 4H is approximately 1.3375. A clean close above this level with momentum confirmation tells me the rejection of the 200 MA has failed and buyers are stepping back in. Entry. 1.3385, after the 4H close. Confirmation stop loss. 1.3315, 70 pips below entry. This is below the 1.3320 level that UOB identified as the next major support, giving the trade room to breathe. Take profit 1. 1.3440, 55 pips. This is just below the 1.3445 resistance that rejected price last week. Take profit 2. 1.3480, 95 pips. This is the level UOB flagged as the next watch if 1.3445 breaks. Risk reward. TP1 gives us 0.8 to 1. TP2 gives us 1.35 to 1. Trailing stop rule. Once price reaches halfway to TP1, around 1.3412, I move my stop to break even. The explicit invalidation level, a daily close below 1.3300. If we close a daily candle below that level, the entire medium-term bullish structure is broken and we are looking at 1.3210 next. The session SRNG entry. 1.3385, 4H close above 60 MA with bullish MACD cross, stop loss. 1.3315 take profit 1. 1.3440 take profit 2. 1.3480 risk, reward. 1:0.8 R, TP1. 1:1.35 R, TP2, invalidation. Void if daily close below 1.3300. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. The liquidity grab setup has a 1-to-1 risk reward, so position size accordingly. No positions through high impact news. And tomorrow's CPI is exactly that. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session. 1.3364. That's the 200-hour moving average. If we hold above it going into the US CPI print tomorrow, expect a squeeze back toward 1.3399 and potentially 1.3440. If we break below with conviction, the next stop is 1.3338, then 1.3323, and if that goes, 1.3300. Tomorrow's focus, US CPI inflation data drops at 8:30 a.m. Eastern Time. Consensus looks for headline inflation to fall month-on-month, but core CPI is expected to hold at an uncomfortably high 0.3%. The rule of thumb remains, any beat to expectations boosts the dollar, any undershoot waste. If this 1.3364 level breaks on that CPI print, the whole monthly trend flips. I'll have the updated blueprint 24 hours from now. If you want the full breakdown on trading commodities, Aussie, Japanese yen, Eurodollars, and Bitcoin, the videos are live now. Tap the end screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. Scalp the noise. Swing the trend.